Hey there, welcome aboard. Walter here. Glad to have you here. We are going to talk about risk management and achieving your trading goals. So, what I want to share with you first, actually, what I'm going to do here is I'm just going to talk about probably the most important thing when it comes to achieving your trading goals. Although a lot of times we don't look at it this way as traders. I had a friend, he was trading a system where he automated it, and every day the system would make just a few pips, just about 3 to 5 pips every day, and it did it pretty consistently, and he built it up over years and years. But occasionally what would happen is the trade would be wrong, and he had a really wide stop because he was trading during an illiquid market, so the market wasn't the spreads were a bit wide, wasn't a lot going on during this time of the day. And so the way he set up the system was he might actually find that he would occasionally get stopped out for a big loss, essentially, for a really big loss. And so the loss might be, I don't know, 3 times or up to 10 times what his risk was, 6 to 10 times what his risk was. And so the tricky thing for him in his balancing was, how much do I risk on the initial trade trying to make 5 pips so that if it does go bad and I get stopped out, that I am okay with that loss. And so that was really what it ended up being for him. It ended up being this balancing act between risk and reward. And that's really what trading is all about, isn't it? It all comes down to risk versus reward. So here's what's interesting about what he did in the end. Essentially, he decided that the system would reverse. So if his initial trade didn't make the 5 pips and it hit the 30 pip stop loss or the 40 pip stop loss or wherever it was at, he would reverse his position and really go in really hard. So if it was a buy, he would sell. If it was a sell, he would buy, but he would go with a much bigger position. So there's a bit of a martingale element to that. But he had to think in terms of, if that second trade is stopped out, where is my uncle point? So that's really where he started, and that's how he calculated his risk for the initial position, assuming that it would go bad, he'd have to reverse it and put on a much bigger position. So this strategy worked for him for years and years and years. And I said to him, eventually it's not going to work. Eventually what's going to happen is you're going to have that catastrophic drawdown. And he understood that. But the important thing is, he understood what he was doing. He was able to build up a small account and make it went for years and years. I don't know exactly where it's at today. But the interesting thing was it worked for 3 or 4 years the way it did. I think that the day of reckoning was coming, and I think he understood that too. So this is something that you need to think about as a trader. How are your risk management rules or your risk management algorithm? It is an algorithm, whether you formally acknowledge it as that or not. How are those helping you achieve your goals? Have you thought about it in those terms? Because that's a very useful way to do it, I think. We're going to talk about a lot of this stuff in the small account big profits course. If you're interested in that, you can click the link below or above or wherever that link is and get more information about that course. So basically, your risk management algorithm allows you to get what you want out of your trading. So your goals are achieved through your risk management profile, your risk management goals. So for example, the first thing you might have to determine is, what's my biggest loss that I'm willing to take? If you understand the biggest loss that you're willing to take, that might get you to your sleeping point. If you ever find it difficult to sleep at night because you have positions on, then that probably means that your positions are too big. It probably means that the risk associated with those, if everything went bad, is too much. That's probably what that means. That's number one, is to determine that. And I have this handy dandy calculator that I'll link up for you in the bottom of this video if you'd like to use it, because it'll help you figure out exactly that. What's my maximum drawdown? What's the probability of hitting my maximum drawdown? That's the number one thing, because most traders quit because of the drawdown. They don't quit because they're making too much money. They don't quit because trading's too stressful. They quit because they hit a drawdown that they weren't willing to stomach. And so that caused them to revisit their trading and say, is my system broken? Has the market changed? Is this for me? That's usually what happens. Number two thing is, what's your true objective? What are you trying to get here? What is the risk that you're willing to put up to get the reward? So for example, it could be that you want to just make sure you don't have a 20% drawdown or a 10% drawdown. I know a trader who doesn't want to have a 5% drawdown. That's too much for him. So really, that could be number one. It also could be that maybe you want to make 100,000 over the next 300 trades, which is basically my goal for the Small Account Big Profits course. That's the goal. We'll see if it happens, but that's really where we're starting from there. It also could be that you want to maximize your returns, you want to swing for the fences, and you have no care in the world in terms of what your drawdown may be. If that's the case, then maybe you're trading a bit like Larry Williams did in the World Cup of Trading Championships, where he took 10,000 to 1.1 million. It actually went to 1.9 million, and when the event was over, he was down 900 grand. A lot of people don't know that, but it's interesting because if you're willing to do that, then you actually have to stomach any kind of drawdown. 90% drawdown, sure, I'll take it. Because that's what Larry Williams had to sit through. He had to sit through a 90% drawdown. Maybe you're willing to sit through an 80, 70, 90% drawdown because you know that you're likely to hit your goals if you do that. So you could do that as well. See, most people are looking in the wrong place when they're trying to improve their trading. They're not looking at the risk and how that interplay determines your results. They're usually looking in terms of the system, trying to find the better system, the best system out there, the system that's going to make the most money. When really tweaking the risk is where you can fine tune the risk to reward, finding out, okay, well, I'm willing to take this amount of drawdown, knowing that I'm likely to achieve this amount of results in a certain amount of time. That's really what it comes down to. It's a lot like surfboards. Surfboards are designed to do one of two things: go straight really fast or turn rather easily. So you can have a surfboard that turns really easily, but it's not going to go very fast straight. It's not going to go straight very fast. Or you can have a surfboard that goes really straight and really fast, but it's a little bit difficult to turn. So, and that's really what trading is. It's drawdown and payoff. You can have a lot of payoff, but you're going to have a lot of drawdown. You can have a very little drawdown, but your payoff is going to be muted. So that's how that works. So the difference between trading results among traders is often the risk management algorithm, the rules that the traders use. It's not the system. You and I can trade the same system. We'll come up with completely different results because, why? Because we are using different risk rules. So you can self-sabotage your trading if you don't understand the impact that your beliefs have on your trading. If you believe that a 20% drawdown is too much, and you've set up your risk so that a 20% drawdown is 90% likely over the next 1,000 trades, you're in trouble. So, nearly all systems are designed to make money, especially if you have a higher reward risk ratio. If you have that in place, it makes it easier in many respects. You can certainly make money with a low reward risk ratio, but the pressure is on them to perform and to execute to a high level. It's possible, but it just changes the focus a bit. And your broker can kind of screw you up a bit there too with slippage. But the important thing to note is that almost all these trading systems out there that you can find freely on the internet, my system's in the Naked Forex book, maybe you've read that, I don't know, it doesn't really matter. But anything that resonates with you, it's probably going to work. The thing is, you've got to make sure you're trading in the right market. You got to make sure it fits with what you believe about the markets. And you got to make sure that the risk management goals that you have, the risk management rules that you're placing on top of this system like a wrapper, is going to put you in the right spot. And you're not going to end up with a terrible drawdown or what have you. So let me share with you what this looks like, calculator for you. So the way that this works is you just plug in the elements that you need. Okay? So for example, if we go down here, you're going to see I can plug in my win rate. Let's say, for example, I have a 43% win rate and my reward risk ratio is 2.2, and I'm going to risk 5% because I'm going to go hog wild over the next, I always put 10,000 in here. And I want to know, what is my risk of drawdown? There's a video up here that will help you figure out how to use this calculator. But let's say, am I going to have a 50% drawdown? I probably will, I can tell you right now. But I have a 43% win rate, 2 2.2 reward risk ratio, and risk 5% on each trade. And over the next 10,000 trades, will I have a 50% drawdown? The answer is going to be yes, sir, 100%. What happens if I reduce this amount to 3% per trade? Will I have that 50% drawdown? Well, now it's a 50-50 proposition, so I might as well assume that I will. And if I risk 1% per trade, will I have a 50% drawdown? Probably not. You can keep hitting the calculate, and it'll keep running it because it's running a Monte Carlo test in the background. And you can see it's not going to happen. I might be able to, maybe I move it up to 1.5. Is that going to move me above 1% here? No, I'm still under 1%. So I might be willing to take a 99% risk there. So 99% of the time, what that's saying is with that system, a 43% win rate, 2.2 reward risk ratio, and a 1.5% risk on every trade, using the fixed fractional risk management strategy, which I'm not necessarily saying it's the best, it's the most common one by far for traders. So if you're using that over the next 10,000 trades, you have a 99.9 really, 99.9% chance of avoiding a 50% drawdown. So that's what that means. We're going to use other risk management strategies in the Small Account Big Profits course. If you'd like to get into that, you can click the button below or above or wherever the heck it is, somewhere around this video, and I'll see you soon. I hope this helps, and I wish you happy trading. See ya. Bye.